Hello, everybody. It's Hammer here with your weekly mortgage market update. And this week it is December 14th, 2022. We've got a couple of guests this week. This week we are joined by Nathan Nottingham and Jerry Avila. Nathan, please, I don't know if anybody in the vetted VA community knows who you are. Maybe introduce yourself for a minute.
It's been good the last few months. This 2022, I've really been rolling back, and our VA professionals are taking the lead in such an amazing way. And yourself, Hammer, so thank you. But yeah, I run operations with VA with Christopher, and I was like, hey, I'm gonna hop on this call too, and it'll be fun. Let's talk.
Absolutely. And then Jerry Avila is a mortgage professional. Jerry, please just take a minute and tell us a little bit about yourself.
So I am basically the branch manager out here in the Oxnard branch of U Mortgage. We're known as Vision Financial Group. I've been in the profession for, since about 2005, I think it was, 4 or 5, somewhere around there. I originally started out in Countrywide and then moved into B of A when they bought it out, and then eventually went into the broker channel. And been doing it ever since. So it's been an awesome ride and awesome way of kind of learning the business and trying to help more people instead of trying to keep them in homes and now getting them in homes. So it's
awesome. Well, thanks both of you for joining us today. And Jerry, you're also a VVA4 with the vetted community, correct?
Correct.
Awesome. So you are a vetted professional for anybody that wants to ask you those questions. You've been vetted so that we know that you know what you're talking about. So everybody should remember that as well. So, all right. Well, if you're here live, do me a favor, go ahead and say hello for us. Because I usually see just like Facebook user, you can go ahead and give us your name if you like as well. I do see a couple of you are on already. Remember, if you're watching on the replay, do us a favor, go ahead and just give us a hashtag replay. I know that not everybody can make these live. We are here for you all week though. So if you do have any questions or comments after you've watched this on the replay, feel free to put them in the Facebook post. We'll make sure that we answer them for you as well today. So if you've got any questions or comments at all, go ahead and give them to us. We'll be glad to answer those for you. Let's start off this week, gentlemen, with a rate recap. What I'll do is just give a little bit of what I've seen over the last week. And then Jerry, I'm going to bounce to you next and ask if that kind of coincides with what you've seen and have you add anything you'd like to add. Okay. All right. So basically what I saw over the last week, rates have been basically unchanged since we met with everybody last week. However, that was until yesterday. And if you guys remember last week, I talked about we were going to get a report about inflation, consumer inflation that was going to come in on Tuesday. And that was a really integral report. It's called the CPI report. It's a consumer price index. And they break that down into what they call a headline number and a core number. The headline number, the CPI inflation report, is actually they take a basket of goods, about 250 goods, and they price them out and they compare that to the price a year ago and the price last month. And that's where they come up with this data. And the core CPI number takes out some of the more volatile numbers, which is generally energy and food. So usually your food and energy costs are out of there. So we saw a small improvement month to month. It came in just slightly better than expected, but it was still showing that inflation is improving. It's becoming less of an issue. It's signs of slowing down. So what that did is it helped rates to improve yesterday, and we saw them improve again on average. And remember, this is an average, and your unique situation is unique to you, but on average about 1/8 of a point, so 0.125%. In some instances, you may have seen a change of as much as 1/4% or maybe 0.25%. We did see rates actually change during the day for a lot of lenders yesterday, though. There was a lot of movement in the mortgage markets after that data came out. So it started out in the morning a little bit better than where it ended the day at the afternoon. Remember, VA rates right now, they're generally, for those of you that always ask, like, where are they? They're generally in the high 5s to the low 6s. But of course, you want to make sure that you talk to a vetted professional so that you can talk about your unique situation, your credit score, the different variables that could affect your rate. So Jerry, what did you see? Did you see something similar to that? Where do you think rates are at these days?
Yeah, no, that's kind of right on point where what I've been seeing as of right now. I think it's just kind of seeing how the market digests information and what it does. I mean, ultimately, we have no control over that. It's how it's taken in, right? So we just kind of look at it and process it and try to give as best of a observation that we can, and hopefully be able to guide our clients and our consumers the best we can.
So for those of you that like the technicals, this is a screen I just put up, and Jerry and I are going to talk about. This tells you a little why mortgage rates change and why we saw that change yesterday. So I talked about that inflation data, and what that did is I talk about the markets. And when I talk about markets, I'm specifically talking about the bond market. And there's two bonds that we watch in particular. We watch the 10-year Treasury and the 10-year Treasury yield, which we always want to see going down. If the 10-year Treasury yield is going down, that's an indicator that mortgage rates have ability to possibly improve. It doesn't mean that they will improve. The 10-year Treasury does not set your mortgage rate, but it's a good indicator. It's kind of the granddaddy of bonds. And yesterday we saw that actually improve. The day before it was at 3.61. Yesterday it ended the day at 3.51. So when you see that number go down like that, that yield drops. That's a good sign and usually will correlate with better mortgage rates. And then this chart here on the left with all these fancy little bars, these are Japanese candlesticks. And yesterday, I'm going to zoom in so you guys can really see this one. Yesterday was this long green candlestick here. And the reason we have colors, it's to celebrate Christmas, of course. No, the red is for bad days when mortgage rates may get a little worse. Green is for good days when rates get a little bit better. And what we want to see on bonds, we want to see these actually go up in value. The better the bonds perform, the better mortgage rates can be priced. So when we started the day, we started out down here, which is a little bit lower, and we improved after that data came out. And we actually got all the way to the top of this thin line. That's called a wick. That's the highest point that the bonds were at when they were selling. But by the end of the day, they had settled down a little bit, which is why we had seen rates in the morning. Mortgage rates were often a little bit better than they were in the afternoon. And that's why it's so important when you shop around that you shop around and compare quotes in a very timely fashion. So, because you can see movement just within a few hours. So they started out a little bit better in the morning, but they did settle down. This is where they ended the day. Still quite a big improvement. You see the length of the body, the thick part of this candlestick. And then also today, we've got a little bit of continuation. We're seeing things improve, but things are going to get a little bit crazy today. Do you know what's going on today, Jerry?
As of right now, you'll have to forgive me. I don't recall. Right,
it's National Ice Cream Day. No, today's the Fed Day. Today's the Fed Day. So and so today what we're going to see is as far as where rates are going to move in our rate forecast, a lot of that hinges on what we see today. The Fed is going to, they've been meeting yesterday and today, and they're going to come out at 2 p.m. Eastern time in about 2 hours. And they're going to release their policy statement, which is where they think the economy is, the state of the economy. And they're going to talk about their policy rate and specifically something called the Fed funds rate. Where did that go? Let me pull this back up so I have this for you so I can show you guys. So I've shown this to you many times. It's one of my favorite things to share. Actually, I closed the screen share altogether. Let me open it back up here. Here you go. Okay. So today they are going to come out, and right now these are called Fed futures. And this is the expectation of where the Fed is going to take rates on today's meeting. And right now we're at 3.75%, and that's the Fed's policy rate called the Fed funds rate. And it's kind of the basis of where a lot of other rates come from. It doesn't directly affect your mortgage rate, but mortgage rates will be influenced by what the Fed funds rate does. What they're expected to raise that rate by 0.5% today. There's some expectation about 1 in 5, about 20%, that we could see that go up another 0.75 or 0.75 of a point today. Now we've seen 4 3/4 point increases in the last 4 meetings. And today is the first time that we're looking to see the Fed ease back a little bit. And that's going to help to settle things down. Hopefully rates aren't going to continue to have to move much higher. But based on what that Fed says, when they come out with those rates today, that's going to make a big difference on where things are at for the next few weeks. So we could see a lot of movement today. If you're currently under contract, make sure you're talking with your mortgage professional. If you're out house hunting, today could be one of those days where you'll see rates move, but don't panic. If the Fed does like what they've seen as far as inflation, and they give the idea that maybe they won't have to raise rates over the next few meetings as much as we thought, that's going to help mortgage rates to improve a little bit. However, if they come across with a message that says, well, we're not really convinced and we still are going to need to raise rates a little more aggressively, then we'll see mortgage rates react a little negatively to that. Are we going to see rates shoot back up to the 7s today? No, we're not going to see that, but we're also not going to see them drop into the 4s. So generally we should should see a little bit of movement today. And also at 2:30, we're going to see Fed Chair Jerome Powell come out with his press conference. It's available on YouTube. It's boring for most people to watch. I actually enjoy it. But what you do get to see, that's going to have a lot of effect on mortgage rates. We see a lot of volatility in the movement. So if you got a rate quote yesterday, today it could be different. Make sure you refresh it, and we'll see where that goes. So that's kind of what I see happening and where things are going. Jerry, do you have any questions or anything you wanted to add to that?
No, just simply the fact of how they approach it, right? That's going to make the biggest difference. We keep talking about how hawkish they've been over the last few months, right? And and it's really just kind of seeing the approach. Are they going to take a more dovish approach where they're just going to soften up some of the terms that they've been using? Because the way they approached it last time was a little bit like softer, but then all of a sudden when he came out and spoke, it got more aggressive in regards to, we don't feel like it's really impacted. So, really seeing that approach and that view stance of how they're going to position themselves on that conversation post the meeting, that's going to really be the huge indicator as to what the market's going to end up doing.
Yeah, absolutely. And we have 7 weeks until the next Fed meeting, and it's actually concludes on February 1st. So over the next 7 weeks, where will rates go? They're probably going to go up or down within, let's say, maybe 0.25%. We shouldn't see very, very large movement. We'll have another couple of inflation reports come in during that time. We're going to have a lot of jobs data come in. We're going to have non-farm payroll data, wage data, what's called JOLT reports. And the Fed is looking for inflation to slow down, but they also know that, unfortunately, we're going to need to see the job market get a little bit weaker. There's a huge demand for workers. I don't know did everybody go on an island that I don't know about? Because I've read that maybe a lot of early retirements with COVID, a lot of people that, got out of the workforce. But do you guys see that? Like, Nathan, do you see that in your market? You're in Texas. Do you see where there's always a struggle for workers today? You're muted, my friend. There you go.
And multi-screen, so my mouse is all the way over here. Swing it all the way over here. All right. So yeah, I mean in Texas too, but I think it depends on the job market, the type of job, right? Those that are more on the professional spectrum, it seems like they're filling the roles faster. But those that are service-oriented jobs, the ones that I started with, the ones that you walk in, you're like, hey, I need to go swing into a store and get this. Well, there's a job, posting for jobs all the time, recruiting. I was just talking we're in a small town up here in North Texas in the Lake Texoma area. And I was talking to a couple of business owners in the chamber, and one was saying they're about ready to shut down one of their restaurants because they just can't keep it staffed. Like people just are not showing up for work. And so my question is then, okay, well, where are the people? What's happening in that? Are there enough high paying jobs that they qualify for, that they are being hired for? And so I'm sitting here going, I don't think a lot of 16-year-olds can do IT work from home. So why aren't they at the restaurant earning their first paychecks? Like, what's happening? So I don't have the answer.
That's a whole nother conversation about parenting and like that.
Right.
Back in my day, I didn't lose you. Am I back? Yeah. See, just like the people for jobs, I just kind of disappear. You can't count on them.
Why are they not coming back? Yeah. So there's jobs, but you're right. We look at the Fed and we look at the inflationary cycle, and you're like, okay, there has to be a reduction in jobs. Like unemployment has to go up a little bit to help balance everything. But if I can't even fill the jobs that are posted for, what in the world's going? Where are all the people?
And that's what happens. It's a big cycle. So the reason that we need to see the jobs come down is when there's a lot of demand and we're trying to entice workers, that usually equates to higher wages. Now, everybody thinks if people make more money, that's good for people. And it is. But the problem is that when you have higher wages, it leads to inflation because those dollars get spent. It creates more demand, which then creates less supply, which means that prices go up. So it's a vicious cycle. And that's what we've seen happen through the post-pandemic era, is that there's been a lot of demand. We also had very, very tight supply. We had all the supply chain issues. And that was the perfect storm to create this nasty inflation problem that we have. So the only way to see it go away is for demand to drop. And that happens when people are less comfortable about what money coming in. If they're concerned, they're going to eat out less. They're going to travel less, and that's where you'll see the effect of that on the economy. That then reduces the demand, which can allow inflation to subside, and it kind of settles to an equilibrium. So that's what we're trying to get back to. We certainly, I hate layoffs. I hate the idea of people not having a job. We don't necessarily want to get too far, and that's what the Fed's trying to avoid. They're trying to avoid having a harsh recession with a lot of unemployment, and they're looking for that legendary soft landing. I don't know, like you jump out of a window to a pile of pillows. That's what they call it, as a soft landing, and that's what they're looking for. But Jerry, I mean, even with rates, a lot of people were like, maybe rates have started to come back down. And when rates went up, people said, I don't want to buy a house because rates have gone up. And now they've started to come back down, and people are like, maybe they'll just keep going down. Do you think now is a good time for people to buy a home, and why?
So I'm in that mindset where I think as long as you have the means and the desire to own a home, then it's the right time for you, right? It's more about your needs than anything else. But at the same time, is the market's going to move no matter what. And if you're buying when the rates are high, at some point you're going to be eligible to refinance that loan and lower that rate. So really, it's going to be based on your needs and wants. Beyond that, though. Right now, it's so easy to try to get a deal in to where you negotiate closing cost credit to create an opportunity for buy downs, or just to get the seller to give you a good amount of credit in order to pay down debt or apply towards your rate to go down. I mean, like, you can do all kinds of different things with that credit right now. And I mean, this is the best opportunity. Home prices are starting to kind of like trickle down, and because of that, those credits are going up. And I mean, it's the best time to negotiate and actually have the buyer have some control over what is going on. So for me, that's kind of why I tell everyone, hey, look, it's based off of your needs and wants. And right now, if you are in the mood to get into a home purchase, take the opportunity to take your advantage while you have it, to try to get as much back in return from that seller, because right now this is the opportune moment for you in that situation.
Right. So if go ahead, Nathan.
Just professionals listening too, and as well as those that are maybe the home buying process, or they bought a home recently and like, man, I'm sitting on a lot. Finances are not, and we've said this before, but you don't close on your house at an interest rate and get a plaque with your interest rate that you're supposed to put up on the door. Like, hey, I got this interest rate for this house, right? It makes us feel better when we feel, and this is a human nature thing, right? I want value I want to pay a fair value for what I think it's worth. We barter. That's great. I like to look around and say, look, housing is an essential in Maslow's hierarchy of needs. Security and housing, shelter over our heads is essential. If you're in a rental position, but you have a dream to purchase and now you can make that dream come true, it's about affordability, not necessarily about price, not necessarily about interest rate. It's about the monthly payment. It's about, can I maintain this? Can I plan ahead? Can I show up and pay this bill? All things considered. So that's where I look at it. Hammer, you and I've talked about this months ago. My first house was at 6.875% on the first and 8.5 on the second. Like, I've been there. Blended rates are everything. And now if you're sitting on a lot of debt, but you have a lot of equity in your house, you might even say, well, yeah, but I'm at a 3.5% interest rate. Look, if you were to refi and cash out at 6.5%, just saying, right? No APRs. I don't know. This isn't an offer to lend, right, Hammer? But you find a better interest rate and you're like, okay, but I'm sitting on all this car loan debt or unsecured debt. I'm going to be in this house for the next 5 years. When you start doing the calculated math on what interest you're paying in the future to pay off that debt but tapping your equity and maybe taking a higher interest rate, this is where you taking pencil to paper and sitting down with a trusted professional and go, okay, let's talk about all my options, even if they're like, I wasn't thinking that was an option. That sounds a little weird. Let's take a look at the whole thing. The nice thing about now, and what you kind of pointed out, Hammer, is that we're at a little bit of this lull where everybody's waiting to see what happens. We went down, we went up, and now we're kind of like, okay, where are we at? Let's get through Christmas. Let's get into 2023. All right, what's going on?
Yeah. And all great points. And it's funny, Nathan, I too bought my house. My first house was at 12%. I had a credit issue that kind conventional rates when I was 98 were generally in the high eights, and I even ended up at 12%. But that house springboarded me. I bought a condo, which I was then able to sell and buy a home, bigger home, which I was able to give back to the bank in 2008 when the market crashed and I went bankrupt. See, that happens to everybody. I always have people like, you admit that? I'm like, hell yeah, I admit that. That can happen. Things can happen. But I did actually rebound back from that and bought again. And same thing, where owning a home was enabled to me to build wealth. So owning a home, even if you're buying it now at rates that are not what you think are optimal, remember, you do have opportunities when rates come down. And that's actually a question that's starting to come up. People that bought a home over the last couple of months and they had rates maybe in the high sixes or the sevens, they see better rates today and they're asking about refinancing. They're asking about IRRRLs. Jerry, as a vetted VA professional, do you mind just take a moment and tell everybody what are the parameters for an IRRRL and when will it be right for them to consider that as an option?
Sure. So typically on an IRRRL, the requirement is that your interest rate is going to reduce by a minimum of 0.5%. And on top of that, you have to recoup the cost of that refinance within a 36-month period. Now, there is no appraisal required. There is no sort of income verification that really takes place at that point anymore. Some lenders will still have overlays where they still want to just make sure that you're employed, but not all lenders are the same on that boat. But at the end of the day, what we're looking for is just to make sure that you're going to actually take advantage of a situation that's going to be good for you, not one that, well, the VA puts those parameters, right? They set them for a reason. It's because they don't want to see loan churning just happening just for the sake of you dropping down by 0.5%. It's like if you're able to drop down by a whole percent or 1.5%, right? Because it's been since, let's say you bought when it was at 7 and then all of a sudden you're refinancing and we're at 4.5. Like that's a huge difference. And for someone to try to offer you maybe dropping down by 1% and be down in the 6s or in the 5s, is that really advantageous for you? Not necessarily. I mean, yeah, you might, depending if you want to apply some of that towards credit towards closing costs or whatnot on that, you can do that. But those are like the main like bullet points that you need to watch out for.
And how long does someone have to wait if they did buy a home over the last couple of months when rates are a bit higher? How long do they have to wait before they'd be eligible for an IRRRL?
So it's 210 days from the date of first payment. So right. Whatever the first payment due date is, it's 210 days from that date moving forward.
Yeah. So just for those of you, and good news is if you're looking at rates and you're thinking, man, I would love to do my IRRRL now, but I only just closed on my house, a month and a half, 2 months ago. Rates will very likely be at these levels or possibly even lower next year when you're eligible for your IRRRL, because if we go into a recession, that's generally going to bring mortgage rates down. And I'm going to bring that chart up one more time and show everybody what was up here. Is if we look at this chart, each of these tabs across the top that I'm about to click on are the projections for what rates will be, the Fed funds rate specifically, what that rate will be over the next few meetings. So as we get into the middle of next year, right now it's expected that rate will peak at 4.75%. Now, depending on what's said today, that may either may stay the same. It may start to go back towards the idea that the Fed will raise rates a little bit higher, or that they may even might get the idea that they'll not have to raise rates as aggressively. But what does happen is as we head into the May, the June, the July meeting, as we get to September, we start to see the expectation that the Fed is going to be able to go ahead and lower rates, and that they're going to need to lower rates to actually stimulate the economy after doing all of these rate hikes, which they've tried to slow down the economy. And today there's a chart that's going to come out. It's called a dot plot. And this one's a very funky looking chart. What this is a projection. Each of these dots is a Fed member, and they're making anonymous projections on where they think rates will be in 2022, 23, 24, 25 for that Fed funds rate. And you can see that we're getting close to capping out. And let me see if I can zoom in on this a little bit just to make this as big as I can for you guys to see on the screen. It looks close to capping out at about 5%. That's where a lot of the members expect it to be anywhere between 4.5% to 5%. But by 2024, that goes down, and you could see the different Fed members start to really kind of get a difference of opinion on how aggressively those rates will come down. Right. But only time is going to tell. But you do know notice that they all do expect them to come down. Well, there's that that 4 out of 5 dentist. There's that 5th dentist right there. But otherwise, like everybody else, they expect those rates to come down over time. So that's going to play well for you. For those of you that have bought a home recently, you probably benefited from those different advantages that I had on the screen a minute ago, where, you were able to get your foot in the door. There's less bidding wars. There was prices have not softened tremendously, but they're also not going for ridiculous amounts over asking price anymore. So it's a great time to get your foot in the door, and then let rates take care of themselves. So, all right, my friends. Well that kind of wraps us up for today. What would you guys like to leave? Nathan, you were just going to say something. Please do.
No, I just said that well said, and I appreciate the forecast and looking forward to that. And really, the CPI was great news as far as leveling things and balancing. We're all like, hey, we made some pretty crazy changes this last year. We've kind of caught up now that the calendar year has cycled back again. It was last October, November that things started changing, and we're like, oh boy. And it takes a while for that to all come up. But now you're looking at the CPI and going, oh, it's only a 0.1 change. Well, yeah, that's actually a really good thing. We're kind of leveling. So I appreciate it, man. Hammer, and just from VetaVA's perspective, I just want to publicly acknowledge anybody watching us later. Hammer, thank you for being on here weekly, to hosting these calls, to talking to our VetaVA professionals and having them engage with you in such a way. I'm getting great feedback from the communities for what you're doing and how you're sharing this, and it's really helping people kind of in the midst of home buying is an emotional, hard, tiring, difficult thing to do. And so being able to come and just listen to somebody explain this the way you do, I'm so thankful. So thank you from VetaVA, Hammer, for everything you've been doing. Appreciate
My
you.
pleasure. Thank you I'm always honored that you guys have let me on here to chat about it. So I actually feel like you're doing me the favor. So, Jerry, thank you for doing us the favor and joining us today. Anything you want to leave everybody with?
No, it's just, I guess just reiterating what I said earlier. It's, I think for everyone who's been on the fence for the last few months, I know it's rough. I know it's hard to look at interest rates and feeling like, I don't know if I'm willing to pay that. Just remember, getting into your own home, you're going to be paying principal towards something that's yours, and ultimately that's only going to give you equity. And when you're looking at the current market and the current environment we're in, eventually these prices of homes are going to go right back up. And when they do, you're going to be the one taking all the advantage of that, while at the same time taking advantage of the difference in the rate market. So don't hesitate to make a decision to push forward if you're already wanting to purchase a home and you're in a position where you can actually make it happen. Because the one thing we want out of everything that we do in here is to help as many vets get into homes as possible. So that's our goal. That's our mission. That's what we're here for. We're here to provide information and value and support. And that's what we do.
Yeah, no, great message. And thank you for that. It's been a couple of weeks since I've talked about the housing bubble. I'll talk about that a little bit more next week, why we're not in a housing bubble. Even if we see prices soften a little bit, like Jerry said, once rates drop down and demand increases, prices come right back up in a rebound. And there's so many homes, and there's a lot more people. It is just a great time. And owning a home helps you build generational wealth. It's one of the best ways that you can get started. And, building equity is something that happens even while you sleep. So remember to join us next week. I will talk about that a little bit more. We do 12 p.m. Eastern time. You can work your time zone off there. I'm never 11 Central, 10 Mountain, 9 Pacific. I got friends in Hawaii, so we'll figure if you're in Japan, you're on your own. You got to figure that out. If you're on base in Poland, sorry, I don't know that one either. So but thank you, everybody. I'm going to go ahead and wrap it up. Merry Christmas. Goodbye, everybody.
I love it, man. Thank you, buddy. Take care.